process of getting inflation down has begun, and it's begun in the goods sector, which is about a quarter of our economy. But it has a long way to go. These are the very early stages of disinflation. This process is likely to take quite a bit of time. It's not going to be smooth. It's probably going to be bumpy. And so we think that we're going to need to do further rate increases, hold policy at a restrictive level for a period of time.
Google laying off 12,000 employees, Microsoft laying off 10,000 employees, Amazon laying off 18,000, HP laying off 6,000, Meta 11,000, Twitter 10,000. What we've seen so far with layoffs is really just the beginning based on what Jerome Powell, the head of the Fed, just dropped yesterday. He was a straight up hawk, and all of the layoff news that we've seen may just be the beginning. So let's go ahead and talk about why all of this is happening.
We're trying to achieve a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. And we don't think we've achieved that yet. If the data were to continue to come in stronger than we expect, and we were to conclude that we needed to raise rates more than is priced into the markets, then we would certainly do that. We would certainly raise rates more.
Of course, we know by now that inflation has just gone absolutely nuts, mainly because the Fed printed trillions of dollars, injecting it into the economy in 2020 and 2021 during the pandemic. This led to a really high inflation rate of over 9%. So the Fed is just trying to get that inflation under control. So how they do that is by raising interest rates. And as they raise interest rates or make money more expensive to borrow, this has led to the bear market in the stock market, in crypto, and it's bleeding into the housing market. And then now we see all of these layoffs that I've mentioned.
Labor market report for January. It's certainly stronger than anyone I know expected. We didn't expect it to be this strong, but I would say it kind of shows you why we think that this will be a process that takes a significant period of time. It's a good thing that we've been able to see the beginnings of disinflation without seeing the labor market weaken. Right now, the labor market is at least at maximum employment, but many would say that it is out of balance with more demand than there is supply. So what we're trying to do is get inflation to come down over time.
Even with all the layoffs that we've heard of up until this point, when the jobs report came back just recently, it came back way better than expectation with a 3.4% unemployment rate, which we haven't seen unemployment rate be that low since 1969. That's ridiculous. However, it's probably not going to stay that low for very long. The reason is because Jerome Powell actually really likes that unemployment has stayed very low so that it allows him to continue to raise interest rates. And as we see him continue to raise interest rates, this is going to force many other companies to begin to lay off more employees.
2% is the global standard. And that is our objective. And that's not something we're looking at changing. That isn't going to change. We're using our tools to get there over time. We expect 2023 to be a year of significant declines in inflation. My guess is it will take certainly into not just this year, but next year to get down close to 2%. If we continue to get strong labor market reports or higher inflation reports, it may well be the case that we have to do more and raise hikes more than is priced in.
Ever since January, we saw an incredible bounce with stocks and with crypto. And this is mainly because many people think that the Fed is going to pivot soon. So they've been lowering interest rate hikes, with the last one only being 0.25 basis points. Many people think that the Fed is going to stop interest rate hikes, they're going to pause, and then they're going to pivot, and then that's when we're off to the races again, reaching all-time highs. But as we just heard Jerome Powell, he says that in order to get inflation under control, this might take all of 2023 and even into 2024. So what he's saying is he's going to keep raising interest rates if the data shows that it makes sense to, or he's going to just keep them high all the way possibly into 2024. And if it's going to be that long, then it's just looking very, very bad for unemployment and for companies needing to lay off their employees.
It is good that we have seen very strong labor market, but at the same time, we're seeing wage increases are still very high, but still well above what would be sustainable with 2% inflation. Inflation is starting to come down and the labor market hasn't softened. We do expect that it will soften. To get inflation down from high levels that we've had, if you look at history, there is some softening in labor market conditions that goes along with that. And that is still very possible and indeed likely here, some softening in labor market conditions.
When Jerome Powell says softening of the labor market, he's essentially saying that layoffs are going to get worse. If the Fed is trying to lower inflation by raising interest rates, he said that history has shown that layoffs are going to get worse, or the softening of the labor labor market. It's happened in history, and so it's likely to happen now, and that's what the Fed is expecting.
We're not trying to hide our decisions from the public. In modern monetary policy, we want the public to understand how we think, how we're thinking. If markets really understand how you're thinking and a new piece of data comes in, the markets will go, well, they're going to do this. And that happened all last year. As we were talking about raising rates, the market priced in rate increases long before we actually enacted them.
It's very interesting to hear Jerome Powell say that the Fed wants us to know, the people to know, that what the Fed is thinking, what they're going to do, so that nothing comes as a surprise, so that we can prepare for it. And so Jerome Powell can't be any more clear to say that layoffs is going to get worse if they continue to battle inflation by raising interest rates. Many people, though, they think that the Fed is going to pivot soon, and so they're calling his bluff and they're putting their bets now into the stock market. So how do we prepare for all of this? Well, first, for me at least, I am saving every single penny. We've made it a plan in my family to cut out expenses that we don't need, just so that we can build up this stack of cash, okay? So that if I ever happen to get laid off at my job, then I'll at least have something to fall back on and not feel too stressed out to find my next job. And if that situation ever were to come where I didn't get laid off at my job, then I would have a pile of cash to where history has shown that once the Fed actually pivots, the bottom of the stock market comes almost every single time. So once the Fed pivots, soon later the stock market bottoms, and that would be the time to deploy this pile of cash that I've saved up to put it into the market, and that would be an incredible time to buy. Otherwise, I'm just saving up my cash and slowly dollar cost averaging slowly into the market, but not aggressively as I used to, and just building up this pile of cash, waiting for the moment to finally deploy it at the right time. All right, guys, that's about it for this video. If you enjoyed it, definitely hit that thumbs up button, subscribe to the channel. My name is Jimmy Invest, and I'll catch you in the next video. Peace.